It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. US CPI drops today. The data may be key for what the Fed does next. Meanwhile, traders ramp up bets that the ECB will hike tomorrow. The central bank expects inflation to remain above 3% next year. And we're tracking oil moves. The IEA warns Saudi oil cuts could ignite volatility. Over at BP, the CEO's surprise exit leaves the oil giant leaderless at a crucial time. Welcome to Bloomberg Surveillance. This is the early edition. I'm Danny Berger in London alongside Sonali Basak in New York. Sonali, I know we got CPI today, but first we have to get through the European data. Industrial production hitting worse than expected. It has fallen 1.1% month over month. The estimate was for 0.9%. Sonali, I know it's blasphemy. I only care about Europe today on a CPI day. So walk us through the U.S. markets before I get too much into that.
Yeah, absolutely, because we are looking at an S&P 500. Futures are down about 0.1% before that CPI print, as you've been saying. The two-year yield above 5% once again ahead of that print. Remember, CPI is expected, core CPI is expected to come in softer than expected, but there's some interesting cross currents that we will talk about. This was at about 4.98 about this time yesterday, so back above 5. We're looking at the dollar index as well, back on the rise. It's very muted moves here, but we are not far from the highs that we saw last week. It has maintained its strength generally, and that has come with the surge here in yields. Now we are looking at Brent crude. This is the really amazing story. We have been talking about this all week. Surpassed 90 last week. That was the highest level since November of last year. We are now at 92.63 heading into this morning, 0.6% higher, Danny. Now, this has just been a steady climb higher in Brent. Certainly interesting. I know traders will be watching core CPI, but with oil rising the way it has been, it certainly sets up a very conflicted story for the inflation picture ahead.
Yeah, and we're going to be speaking with Nadia Martin Wiggin later in the program about just that. First, Sonali, I want to get a check on dollar yuan because the renminbi has been climbing today. We had another fixing from the PBOC. That's me. We'll get back to that in just a moment. We had another fixing from the PBOC, and liquidity is really tight. It's the PBOC trying to fight against speculators. There we go. It's back up. And again, it does seem to be working. The dollar has been weakening against the Chinese currency. Is this finally a sign that the turning point of the dollar is here? Now, elsewhere in Europe, again, we have that industrial production data coming in for the euro area in July, worse than expected. I mentioned the month-over-month figure that missed. Year-over-year, a big miss, too, falling 2.2%. Year-over-year, the expectation was that it would fall 0.3%. And when it comes to the month-over-month for July industrial production falling 1.1%, the estimate was for 0.9% month-over-month. Look, the European data, it is ugly. Even so, we had a leak from the ECB saying that they expect 3% inflation next year. We'll get more into that in a moment. So it would seem that they're hiking, but does the data speak against that? Certainly translating into risk-off, European equities are down 0.7%. You are seeing bund yields, Schatz on the front end, moving higher off the back of that ECB report, about 4 basis points. And in the UK, the data is bad there, too. We had GDP data come in and disappoint. Sterling weakening off the back of that 0.1%. Now, I want to get back to the thing that's been moving this market. It's that story about the ECB. Traders are boosting their bets on an ECB hike after the central bank's new economic estimate will show an inflation forecast for 2024 above 3%. Joining us now on this is Bloomberg's Valerie Teitel. Valerie, does this mean that markets had vastly been underpricing the odds of a rate hike from the ECB tomorrow?
You could say it that way, or you could say that perhaps the ECB had miscommunicated to the markets what to expect this week. This isn't the first time that the ECB has had to leak sources to the media on the eve of a decision, Danny. Now, this comes alongside a lot of hawkish language last week from ECB members, tempting that percent chance of a hike this week ever higher. We crossed 50% for the first time yesterday, and it has now surged to 65% chance of a hike at tomorrow's meeting. That's all due to this leaked story about their inflation projections, especially inflation projections for 2024 are expected to now be revised up. And the ECB uses these macroeconomic projections to weave a narrative to the market. If they're revising those inflation forecasts higher, it does entail there is more work to be done on hiking.
Speaking of hiking, we have that CPI data that the market has been so eagerly anticipating over here in the United States. And even though the expectation here, Valerie, is for subdued core CPI, I wonder how sensitive rate expectations are to that print.
Well, Sonali, it's only my favorite data release of the month, US CPI out later today. We are expected to see an uptick when it comes to headline inflation, but the drama, again, is going to be in that core number, as you mentioned. It is expected to moderate on a year-on-year basis from 4.7% to 4.3%, so quite a big drop. And most importantly, we're expected to get that 0.2% month-on-month core reading again. That is important because if you annualize that figure, it puts us really bang in line with the Fed's 2% target. Now, if we do get that core reading as the consensus expects, that would really cement the fact that we think the Fed is going to go on an extended pause. There it is, that chart there showing the U.S. core CPI, just how much it's fallen recently. And again, that 0.2% month-on-month increase is really what the market is going to be focused on. This fall in core CPI is likely to be driven by cars and rental prices. Again, the Fed is going to be more focused on this core CPI falling rather than headline rising because inflation expectations in the U.S. seem well anchored. So the Fed is likely to dismiss that uptick in headline CPI and focus more on core.
I got to say, it's quite sadistic for CPI to be your favorite data point, considering its propensity to catch traders off sides. Valerie Teitel there. Thank you so much. All right, let's turn to oil now. Trading at a 10-month high, the IEA has issued a warning of price volatility as Saudi Arabia and Russia production cuts threaten significant supply shortfall. The IEA's head of oil market division spoke on Bloomberg earlier.
Market is really tightening in the second half of the year. Already in August, we saw global oil inventories falling by a massive 75 million barrels according to preliminary data. And with the extensions of the cuts by Saudi Arabia, but also Russia through the end of the year, we're seeing global oil demand overtaking supply by about 1.4 million barrels a day in the fourth quarter. So this risk, tightening the market, increasing volatility.
Bloomberg's Will Kennedy joins us now on this. I find it interesting to listen to her comments and also compare that to Fatty B-Roll's op-ed in the FT yesterday saying that peak oil demand is coming. Can both of these narratives be true at the same time?
It may be coming, but it's not here yet, I think is the way to square that circle. Clearly, one of the surprises of the market has been that there were a lot of doubts about the strength of the Chinese demand. Was it recovering as quick as possible as it came out of the pandemic this year? It does increasingly look like the demand is fairly strong from China. There were comments in the IEA report this morning about how they saw record demand in July and August. Clearly, there's some year-on-year effects from the lockdowns, but still it appears healthy, and a lot of the gloom about the Chinese economy and the property sector does not appear to have had a big knock-on effect into oil. So you've got these big Saudi cuts set against a situation where demand around the world looks fairly robust, and that means these big deficits that both the OPEC, which was much bigger than the IEA, but the IEA are seeing for the rest of the year, and that appears to be a pretty bullish scenario for oil.
Now, I want to switch gears here a little bit to that abrupt exit for the CEO of BP, Bernard Looney, who was only tapped in 2019 for the job. Turns out he's not leaving over a strategy hiccup here. He's leaving over a failure to disclose personal relationships. But how much now does that put BP's future in play?
Well, BP's future is very uncertain right now. This exit was unplanned. It was surprising. The announcement appears rushed. They've put the CFO in as an interim leader, but there's no indication of how long he'll be there, who the candidates are for the job, how wide the board will cast the net, and how long it will take them to find a successor. I think all those questions are very open. That leaves BP's strategic direction up in play. And look, it was clear that Bernard Looney set quite a radical direction for BP. He rode it back a little bit, came back towards oil and gas this year. But there are still a number of BP investors, especially in the US, who would like to see them look a lot more like Chevron and Exxon and really concentrate on the core oil and gas and cash returns to investors. So I do think no matter who takes over, there will be investors who see this as a moment to press for a reset of strategy. And it's going to be very interesting to see how that conversation develops over the next weeks and months.
Certainly a lot in the air. Will Kennedy, we thank you very much for your time and your reporting. Now, Apple introduced its latest iPhones at the company's biggest event of the year, including camera upgrades, improved performance, and a titanium finish. Apple CEO Tim Cook praised the new models and the company's ambition.
Since the very first iPhone, we focused on giving our users a device that's incredibly powerful, remarkably easy to use, and beautifully designed. Every year, we've built on this foundation to create experiences that make a real difference in our users' daily lives. Today, we're pushing what users love about iPhone even further.
Now, joining us for more on the takeaways for Apple's Wanderlust event is Bloomberg's Aggie Cantrell. Aggie, the reality is even though Apple might be praising their own ambitions, customers now have to look forward to a higher price tag and changes potentially in the way they charge their phones. What were the biggest takeaways for you?
Yes, so starting with that charger issue, that actually comes from Europe, where basically the EU has said that they need to push for smartphones to be standardized in their nature of charging, which means that the Lightning port will be phased out. Of course, they're already offering an adapter to allow for USB-C charging from the Lightning port. And also the other thing is the price point. They have upped the price for the top-end product. The Pro Max is going to be $100 more, while also being reticent and not raising the prices on the cheaper iPhones. And that's probably because they're looking at maybe the higher end product is what's going to sell to the consumers that will always replace their iPhone every couple of years. And at the time when other consumers are a little more concerned about costs, they're limiting the price hikes in those other versions.
Aggie, I'm so glad you mentioned that the charger was due to EU regulation. I swear I woke up to American media saying, oh, look how nice of Apple changing their charging to match others. Look, while we're talking about iPhones, we got to talk about the news that broke just moments ago, about 30 minutes or so ago, about Chinese government officials voicing their first really public statements about iPhones, saying that there were security incidents within Apple iPhones. Is this an escalation of reports that Chinese officials and governments and state-backed firms will not be allowed to use Apple products, Apple iPhones?
Yes, it does seem to be at least flagging those concerns in a more public setting. There have been reports before about limiting the ability to use iPhones if you are a government official or working for state companies. But they did also stress in this that they are flagging these security concerns, but there is no legal regulation, no bans on iPhones or any other foreign phones being sold in China. So they did make that also clear. But it is important when you look at this from an optics perspective. China is a huge market. It's the largest foreign market for iPhones. And on top of that, it's not just a huge consumer base. It's also where the majority of iPhones are built. And of course, Apple has been trying to diversify that production line, is looking at developing them in India as well. But really, it is a critical relationship for the company, not just as a consumer of iPhones, but also as a producer of them.
Our thanks to Bloomberg's Aggie Cantrell. Now we're also tracking the IPO market. We're tracking ARM, which intends to price its IPO at the top end of its range or even higher later today. The shares are set to begin trading on the NASDAQ tomorrow. Remember, ARM's debut might deliver a much-needed win for SoftBank's Masayoshi Son, which owns most of ARM, all of ARM. Birkenstock has also filed for an IPO, another sign of attraction in the U.S. equity markets, holding for European firms seeking a valuation uplift. The German footwear maker, whose iconic sandals are worn by hippies and preppies alike, and Sonali Basak, will continue to be controlled by private equity firm L. Catterton, Danny.
Man, that surprises me not one bit, because you are a fashion icon, Sonali. I could see you pulling those off perfectly. All right, coming
I'm also
up,
crunchy on the side.
I love it. Oh, our crunchy Sonali. You think she's all about finance? She's a little bit about granola, too. All right, coming up, the EU tightens its grip on Chinese EVs with an anti-subsidy probe. We're going to get more on what was announced by the European Commission President Ursula von der Leyen's annual speech next. And weaker growth in Europe is unlikely to drag inflation down. That's a view from Alberto Gallo, CIO of Andromeda Capital Management. We're going to be speaking to him later this hour. Plus, the IEA warns that oil supply cuts threaten a surge in price volatility. We're going to have more on that still ahead with Nadia Martin Wiggin, director at Svelland Capital. This is Bloomberg.
global markets are now flooded with cheaper Chinese electric cars. And their price is kept artificially low by huge state subsidies. This is distorting our market. And as we do not accept this distortion from the inside in our market, we do not accept this from the outside.
That was European Commission President Ursula von der Leyen announcing an investigation into Chinese subsidies for EVs as the EU frets over the ability of its industry to compete. Von der Leyen spoke in her annual speech to the European Parliament. Joining us now for more on this is Bloomberg's Maria Tadeo in Brussels. Maria, first, why are they doing this? What is the thought process here to launch this probe?
Well, Danny, clearly because she doesn't like what she's seeing coming from China. The language is striking there. She says they've flooded the market with cheap cars, and it is artificially low subsidies. That's how China is winning, perhaps, the battle for EVs. It's also not a secret that the auto industry making cars, this is something that is so important for Europe from an economic perspective, almost culturally, politically, the number of jobs it creates. So obviously she has identified this as a crucial area where the European Union wants to stress it will protect fair competition. Now, she says this is not about competing. The European Union, she argues, is up for competition, but it has to be fair. She says we respect the rules internally in the internal market. Again, we should stress for an international audience, that this is the biggest trading bloc in the world, the EU as a whole, but it also has to be respected externally. Now, there's also a number of issues that go at play here. We know that there's a precedent to this. When you look at the solar panel industry, this is an area where China just wiped out European competition. Perhaps some are suggesting that the EU has now taken the lesson and wants to prevent that from happening into the auto sector because of the reasons I listed. The other big question going forward is how long will this probe take? This is a very complex industry, and we also know the calendar is tricky because there's European elections next year, so it means the Commission breaks up. She wants to get it done before at that point. And then the other fundamental question is, if you get to a probe and the European Union does say, yes, China has abused its market position, does it work if you don't have the WTO involved in it? But nonetheless, Danny, I should really stress this was supposed to be a political speech. She moved markets, and the announcement, look, it's very significant that she's willing to take on China so frontally.
Maria, thank you so much for your coverage. Bloomberg's Maria Tadeo reporting from Brussels. Let's turn stateside now, where the latest inflation print is expected to come out in just over 3 hours. And markets have been quite sensitive to fresh economic data, so much so that the correlation between the S&P 500 and the Citi's U.S. Economic Surprise Index has tumbled to the most negative on record. Let's get to the person behind that excellent piece of data journalism. It's Bloomberg cross-asset reporter Danica Tsekova, who joins us now. Danica, part of the reason I love this is because there are so many people who continue to say that equities are just impervious to reality, that they don't care what's going on. But you kind of show that that's not exactly the case here.
Yeah, so what we've seen is equities actually are swinging between the sentiment of whether good news or good news or good news or bad news. And this chart is showing that they're the most sensitive they've been to actually hot economic news on record, which is kind of a new thing. As we know, for quite some time, we were very worried about recession, so hot economic news weren't an issue. But for the last couple of weeks, we saw some good news on the jobless claims front. We saw the service sector's activity, some good news there. So markets have actually started to react quite negatively to those news. That comes as recession odds have fallen sharply. Both recession odds priced in markets, so stocks, high yield, bonds, everything is pricing much lower recession odds. There is a JP Morgan model showing that the S&P used to price in almost 100% recession odd, and now that number is close to 20. So that huge difference makes hot economic prints very dangerous for markets who are not worried about recession.
All right, so possible fireworks later today, then, for the CPI is what I'm gathering from you. Danica, thank you so much for joining us. Again, great story, Danica Tsekova there. And for more market analysis from Danica and the team, MLive Go is where you want to head on your terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition, and here is what you need to know. That key U.S. inflation report drops today, and the data may hold the kind of evidence the Federal Reserve needs to stay on hold, at least for this month. Meanwhile, traders are ramping up wagers that the ECB will deliver a rate hike tomorrow. Reports show that the ECB expects inflation to remain above 3% next year. And we're tracking the oil moves. The IEA warns that the Saudi oil cuts are threatening a renewed surge in price volatility. And over at BP, a surprise CEO exit leaves the oil giant leaderless at a crucial time. I'm Sonali Basak in New York with Danny Berger in London. Danny, tell us about the European markets today.
Sonali, I said something a bit blasphemy and controversial to start the show. I'm going to say it again. I think that this week the ECB is going to be more critical and more market moving than the inflation report, than the CPI today. I mean, look, it obviously could surprise, but we're already getting surprises being leaked from the ECB. First, Reuters, Bloomberg has matched the story that the ECB will upgrade their inflation forecast to expect 3% inflation into 2024. Perhaps we have mispriced the chances of a rate hike tomorrow. So the market is adjusting. You can see it at the bottom of my screen. Chats, we're seeing those yields, two-year yields in Germany, move up by 4 basis points. We're now over a 50% chance priced in that the ECB does hike tomorrow. Yet we are still seeing economic weakness creep in. We had industrial production figures to start the show. Those were much weaker than expected. We had UK data come in. GDP, that was much weaker than expected. You can see the reaction there with sterling weakening versus the dollar. It's now at 124. Then we are looking at equities, too, in Europe, struggling to find any traction. We are performing worse than 0.5%. A lot of corporate news that we'll sort through throughout the rest of the day, Sonali. But overall, it's a pretty grim picture of battling both higher inflation and weak data in Europe. What about the U.S., Sonali?
Yeah, certainly higher inflation in Europe and moderating, presumably, inflation in the United States. So I will give you the other end of your argument, Danny, here, because you are looking at that two-year yield now roughly 5 basis points higher than the week started last week. Now, the reason that is so important is to the point that you're making here. If CPI comes in so cold, then where are we on that two-year move that has been spiking higher ahead of that CPI print? S&P futures on the back of higher yields also down roughly 0.1%, though that decline has been moderating throughout the morning. The Bloomberg US dollar index also on the heels of rising yields, up very slightly here. Now, we are watching this somewhat plateau. This is not off the levels we saw the highs of last week. However, we will keep watching King Dollar because that is a massive story relative to the rest of the world. Also complicating the inflation print here is that rise in Brent crude, just a stunning 92 handle. I reiterate, that was at a high of 90 last week. Now more than $2 higher, almost $2.60 higher. And remember that last week rise brought us to the highest levels of the year, and we have been on a steady climb upward. Now we are watching the core CPI print. Will this complicate the story, Danny?
And look, part of that, or I should say maybe most of that, has been driven by geopolitics. And off the back of that, the IEA is issuing a warning of price volatility as Saudi Arabia and Russia production cuts threaten significant supply shortfall. The head of the IEA's oil market division spoke on Bloomberg earlier.
Prices are still lower than they were last year when just in the aftermath of Russia's invasion to Ukraine. But still, with interest rates very high and central banks looking at how to ease those, higher oil prices, energy prices in general is obviously a key factor into those considerations. So prolonged high prices risk delaying the easing of monetary policies, which could put the recovery, the economic situation at risk.
Now, off the back of those cuts, Brent crude has risen to its highest price this year, the highest in 10 months. That is a gain of about 8% year to date. Joining us now is Nadia Martin Wiggin, director at commodities-focused hedge fund Svelland Capital. Nadia, so great to see you in person. Great to have you on set.
Thank you.
Look, the unity of Saudi and Russia, a far cry from 2020 when some of that relation broke down. Is this an exogenous shock to this oil market, the cuts, the unity of the two of them?
I think the market has been prepared for this. I mean, since October last year, we've seen that they have been working together on maintaining an OPEC plus stance. I think what we saw a few weeks ago with Saudi Arabia adding on to the BRICS group, that relationship is becoming even closer. So they are definitely not only right now controlling the downside of the market, but also looking at supporting prices even more than most expected off of high summer demand.
I mean, it's so interesting to see above $90 a barrel oil and then also read Fatih Birol's op-ed in the FT yesterday. I think we have a quote of exactly what he said, but he's calling for peak oil demand and peak fossil fuel demand in general the next decade, saying based only on today's policy settings by governments worldwide, even without new climate policies, demand for each of the three fossil fuels is set to hit a peak in the coming years. Do you think he's right?
No. I think we disagree not only on the oil side, but especially on the natural gas side. And this is what happened in terms of that shock in natural gas with Russian gas no longer supplying Europe. The IEA has taken a stance that some of the energy poverty uplift that we are supposed to see in South Asia, in the Far East, isn't going to happen through natural gas. It's not going to be this transition fuel. Instead, it's going to go straight to renewables. And they've really fast forwarded that. And that's where they see peak gas demand coming even sooner than peak oil demand. And that we really disagree upon, that we think there's infrastructure in existence that will be used. On the oil side, yes, we're way ahead of things on EVs. We could be 1.5, ahead of this 1.6 number. But when we look at big, buses, other modes of transportation, jet, aspects like that, there we see that's not quite going to peak as quickly as expected. I think our number would be more like 2032 as a possible peak.
I see.
But what about...
It depends.
What about the pure prices here, Nadia? If you take a look at Brent here, WTI, if you expect volatility ahead, what is kind of the upper end of your range and the lower end, and how do you prepare for it?
In terms of price,
yeah.
how high we can go? I mean, I find it very interesting how a lot of sell-side analysts started off the year talking about $100 oil. They've backed away from that. We hit 90, and we haven't heard those calls, 91, 92, maybe that's where we need to stay, even though we're at the start of their actual thesis, right? That the second half of this year was going to see the stock draws. And we expect that the next month's IEA report in October is going to show a massive stock draw in OECD land stocks. And so that's when I think we'll really get the market on board with how tight this market is, that we need to see that physical evidence. So far, we've seen as Svelland Capital that we have had an unloading of oil on the water. We see that Saudi Arabia is really cutting back on what they're exporting. And that next step is that should feed into OECD company stock levels. When we think about what the market is comfortable with, I would say $100 to $110 a barrel has been an investor's sweet spot that it doesn't shift the whole chain. So we have a ways to go higher before I think people really start to get very worried.
Well, how much does...
On the downside, the market looks very tight now. So we could, of course, pull back to where we were. But that $80 price floor is definitely very solid. And the momentum right now, the path of least resistance is upwards.
Quite the price range there, quite the volatility. But what do you think about the demand picture here? How sensitive are prices currently to this idea of slowing growth in so many economies?
So what we've seen has been the biggest headline, right, is what is happening in China, right? We read bearish headlines day in, day out. But when we look at imports of oil, when we look at imports of iron ore and prices and copper, that's not actually been the case. So we are skeptical that things are as difficult as is presented at times. When we look at refinery margins, they're still solid in the Far East, where you have a lot of refineries that are not of a very high quality. They're still able to do well, even though they need heavy oil, which is what Saudi Arabia and OPEC produce. So we see that the end user is still able to pay for gasoline, diesel at these sorts of levels. And OPEC's made it very clear that they don't want that upside going only to the refiners. They actually want to take some of that upside for themselves.
Nadia, to switch gears a little bit here, we had the surprise resignation of BP CEO yesterday, Bernard Ludy, over improperly reported relationships. I want to put that aspect to the side for a moment, which, of course, I mean, in reality, we can't do because this is an issue. As one person said to Bloomberg News, when will these executives learn? It's clearly a problem. But Bernard Ludy did see this planned overhaul of BP to make it more of a renewables company, something that shareholders punished the company for. Does this put the oil major's trajectory for that goal in challenge? Do you expect BP to continue in that line of change?
Well, when we look at the share price reaction this morning, BP is up, as is the oil price. So right now, investors are thinking of them as an oil company. So I think there is this opportunity that from an investor perspective, ourselves included, that it will do that changeover. When we compare Shell, which had the major overhaul already, right? They now have an official target of 6 to 8% IRR on all projects in renewables and in oil and gas. It's the same across the board. Equinor has an IRR target of 4 to 8% for renewables projects. And the problem is, even though we all want to save the world and climate in particular, there aren't enough projects available right now, especially with the bidding wars, to get those kinds of returns. So I think this is an opportunity for BP to do a rethink and think, okay, we're still dedicated towards this, but we have to focus on shareholder returns and then meet our targets.
Yeah, certainly makes a lot of sense. And again, fascinating you point out that renewed correlation between oil prices and BP, if I can find my word, shares. Nadia, it's so wonderful to have you on with us this morning. Thank you so much for your time. Nadia Martin Wiggin of Svelland Capital. Now, coming up, we're going to be speaking to Alberto Gallo, CIO of Andromeda Capital Management, next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Shonali Bassick in New York with Danny Berger in London. Now to today's US CPI report, the big story of the day. The data may show that consumer price gains accelerated to 3.6% year on year and 0.6% month on month in August, thanks to rising energy prices. But core CPI may rise just 0.2%, the kind of evidence the Fed needs to stay on hold this month. Now, joining us now is Alberto Gallo, CIO of Andromeda Capital Management. What do you think? Good morning. What do you think this means in terms of the Fed's course moving forward, given the cross currents you're seeing between core CPI and food and energy prices, particularly energy still running so hot?
Essentially, we have reflation risk in the United States, and the picture has really changed over the past few weeks. We had 500 basis points of hikes from the Fed, but we still have a strong jobs market. The workforce participation has increased, but the job market is still overheating. We have female participation growing, but there's lack of workers. And we have oil at $90, and the U.S. is an exporter. Consumer demand is still strong. So we're a lot more worried about reflationary pressures in the U.S. into year end. The situation in Europe, where we are physically, is very different. It almost looks like the U.S. went to the party and Europe got the hangover. So growth in Europe is a lot weaker, and as well as in China. But the U.S. consumer and the government demand, with still 7% fiscal deficit, is still pretty resilient. So, we're very wary of higher yields, and we think the Fed will have to hold rates higher for longer. Looking probably at another hike between now and year end, and rates stable next year. There's too many cuts priced in 2024.
So when you look at, as we're speaking right now, you have the two-year yield riding even higher, just about a basis point at 5.03. The 1-2 punch of CPI today in the United States and the ECB rate decision, what does this mean for the divergence of policies? And are there any repositionings that need to happen in the market to capitalize on what may come the next 24 hours?
So there's some commonalities in what the ECB and the Fed are doing. They're both looking at pausing, but I would say the growth picture in the Eurozone is very different, with Germany and the automotive industry and China demand being very weak. I think here the ECB is a lot in a bigger conundrum with weak growth but persistent inflation, and we have seen yesterday night a headline about higher inflation forecasts for core in the eurozone above 3% in 2024, but growth is weak. So we think the ECB is pausing with another hike into year end at most, but the ECB risks making a policy error if they go further. But the situation in the market and with the Fed is very different, because the market is pricing over 100 bips of cuts for the Fed next year. And we think that's not right, with US elections coming up and still very persistent spending. So we're looking at more divergence with a stronger US economy, a stronger dollar, higher US rates, both in the front end and the long end. Eventually, this needs to also affect risky assets, which have been very comfortable in a pivot view with this
Alberto,
view of cuts.
if I can jump in on the idea of weaker European growth, because you're talking about Germany. We just had these breaking lines cross, a scoop from the Bloomberg team that the German government is now going to be predicting a contraction for this year. Previously, in April, they had predicted a 0.4% growth. They might see a loss as much as 0.3%. It almost feels like the German government doesn't want the ECB to hike tomorrow with this kind of leak. But Alberto, this market has now moved to pricing in a more than 50% chance that the ECB hikes tomorrow based off of that inflation report, which you hinted at. I guess this is the thing. Can the ECB afford to hike, or will something break if they don't end their hiking cycle now?
The problem is ECB has started late, and so they're pushing on the brakes very late, and the passenger is flying out of the window, unfortunately. And so here, it's almost like a lose-lose. I think what they should do is pause, because there's been a lot of weak data. But the euro is very low, and they have accumulated some sort of credibility issue over the past few quarters. So they don't want to look bad by pausing too early. But the ECB has been mirroring the Fed too much in a weaker economy, and I think that we are right to price a hike between now and year end for the ECB, but ultimately that might be. So I think the markets are on point with pricing around the hike, for tomorrow, and if not tomorrow, sometime into year end, because core is very sticky, and that's a problem. But it might turn out to be a policy error for the ECB to do one more hike. I think essentially they might do it, but it might turn out to be a policy error.
Okay, so Alberto, if Europe is too weak potentially for another hike, if we've priced in too many cuts in the U.S., yields need to move higher across the curve. To me, that says nothing can get in the dollar's path from strengthening. Can anything remove the crown of King Dollar in the scenario that you're laying out?
Well, I mean, it also does depend on risk. And I would say that for now, we need to see a stronger dollar. But, the amount of deficit, the amount of supply that we are going to see also can impact the dollar long term. There's been a lot of discussion about de-dollarization and sort of the fall from the number one reserve currency. I think that's a very far away story, and what we are seeing instead is a bigger divergence in the strength of the U.S. economy versus China and versus Europe, as a consequence of what's been happening in the last few years and the faster recovery and intervention that the U.S. has made. So for now, we're not against a strong dollar. We're continuing to think about strong dollar against the euro, against sterling, the other thing to think about is the long end. That's really the elephant in the room, the 10-year. We can see a 10-year going up closer to 4.5%. And here the BOJ is really something that markets have ignored. And the BOJ can raise long-term yields. The missing piece in the puzzle is risky assets. They've been extremely resilient in the hope that rates would go down again. But we do think that some correction there is due if we continue to see higher yields.
Alberto Gallo, I've got to say, you've been reading our mind on the questions we had next. We do have to leave it there. But a really heavy day of inflation data ahead. Alberto Gallo of Andromeda Capital, we thank you for your time. Now, coming up, a look at some of the stocks moving ahead of the U.S. market open. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Sonali Basak in New York with Danny Berger in London. Now, a look at some of the stocks we're watching in pre-market trading in the U.S. Traders are watching closely the negotiations between the United Auto Workers and automakers to prevent a strike. GM, Ford, Stellantis, they're all under pressure to meet the demands of the UAW. A strike, even if it's a short one, would ripple across the U.S. economy. Now, Oracle still sliding down after sliding the most since 2002 on slowing cloud growth sales, a market that was hot just a couple of years ago and now is facing some pressures under business spending. And lastly, Danny, the ARM IPO, oversubscribed. Pricing tonight. Bankers in the company are trying to bring up that pricing by perhaps $1 if they can. It's kind of like when I was learning how to drive stick shift and I was stopping and starting the car. That is what this IPO market is like today on the pricing front.
I was going to say, hopefully it's not like when I tried to learn stick shift at 16 years old, driving my boyfriend's Jeep and crashing it into a ditch. Let's hope it's not like that.
Let's very much hope it's not like that. You know, there's also the Birkenstock IPO that filed, Instacart starting next week. I know you and I are kind of excited for the Birks.
I'm so excited for the Birks. Can I say one line in the Bloomberg News story about it, saying that Birkenstock has become a high-fashion brand launching collaborations with luxury names such as Dior. Our producer, Natalie Pack, says she'd buy a Dior Birkenstock. But would you, Sonali Basak?
I would just wear the plain old Birkenstocks, and I wore them to work the other day, and I thought Tom Keene was going to roll over in disappointment. Now, speaking of Tom Keene, that does not do it for Early Edition Surveillance today. Surveillance is up ahead. This is Bloomberg.